Today, we're going to talk about everyone's least favorite topic, and that's taxes. And in particular, we're going to talk about taxes on your Social Security benefits. About 40 years ago, only 10% of people had their Social Security benefits taxed. Today, it's closer to 52, and it's going to grow soon to 56% of people are going to have to pay tax on their Social Security benefit, which is going to cut into that precious bit of money that you desperately need. Now, the good news is we have a strategy to help you significantly reduce the amount of your Social Security payment that's taxed. But before we do that, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. So how did we get in this situation? So in the early 1980s, Congress and the president decided to tax Social Security payments. So up to 50% of your Social Security income could be potentially taxed based upon some formula. So then again in the 90s, Congress passed an additional piece of legislation that allowed up to 85% of Social Security benefits to be taxed on high earners. I'll put that in quotation marks because when you see the numbers in a minute, you're going to say that's a high earner. And the problem is, and the reason that it used to be 10% of people were subject to this tax, and now it's well over 50% of people are subject to this tax, is because the limits of what amount of income is subject to taxation hasn't increased. It hasn't kept up with inflation. And so as you have cost of living adjustments, the amount of Social Security income people are receiving is beginning to increase, but the tax formula that they use isn't being updated. And so that just means that almost everyone is going to end up being subject to Social Security tax unless you have a strategy for getting around it. So that's kind of the background of how we got here. So let's talk for a minute about the formula they use to calculate whether you have to pay tax on your Social Security payment. It's a bit of a convoluted strategy. It's called the combined income or the provisional income. And so to see if you have to pay tax on your Social Security payment, what they do is they take your modified adjusted gross income. So that's all the money you earn from maybe a part-time job, from a pension, from an annuity, maybe a distribution from your IRA or your 401k. All that money gets lumped in and considered income. And then the next piece that they look at is they take any tax-exempt income that you have coming in. Typically, that would be money from a municipal bond, which is normally tax-free. That gets added back in to create this provisional income. And then they take your Social Security payment, whatever your annual payment is, and they count 50% of that income into this provisional income number. So let's, just for easy math, let's say you have $12,000 in IRA distributions, you don't have any tax-exempt income, and you have $24,000 in Social Security payments. Your provisional income or your combined income would be $24,000 a year, and that's the number that's then going to be used to determine whether you have to pay tax on your Social Security. Is everyone tracking with me so far? My numbers, my retention numbers on YouTube aren't plummeting yet. Okay, now let's look at the next piece. Who then has to pay tax? So then the next piece is who is subject to paying this tax? And we have these numbers, and these are the numbers that haven't been updated in a long time, which is why more and more people are subject to Social Security tax. So if you're single and you're earning under $25,000 a year, or you're married and earning under $32,000 a year, you aren't subject, your Social Security income is not subject to tax at all. Which this is also the time to point out that there's a bit of a marriage penalty built into this, because if you had two single people living together, they would each have $25,000. If you have a married couple, it's only $34,000 before their Social Security benefits begin to be taxed. So you take these numbers, and if you're in that bottom tier, none of your Social Security benefit is going to be taxed. Then if you step up to the next tier, so if you're in that 50% bracket, let's say you're earning $24,000 a year in Social Security income, then 50% of that is going to be taxed. So $12,000 gets included in your tax formula, and you're going to have to pay tax at whatever tax bracket you're at. Then the next tier, up to 85% of your income, is subject to income tax. Now, we're just talking federal here. State's another whole situation. So there's actually a couple different formulas and a way they end up working this, but this is kind of the most simple and easy way to understand it. I'm actually going to switch here, and I'm going to show you on going to walk through what calculations might look like using this tax calculator that's online. It's just for financial advisors, but you can go ahead and use it. I put the link in the show notes, so you can get on there and kind of run your own calculations. So let me run some numbers here using this online tax calculator to kind of put everything into perspective. So we're going to say it's a single filer. The amount of your annual Social Security benefit is $24,000. and the amount of your taxable income excluding Social Security. So everything else that you have coming in, your IRA distributions, your pension, annuity, all that income, it's going to be here. It's $24,000. We're going to just not make any adjustments. If you were working and still making a contribution to an IRA or something, you could put those deductions there. But we're just going to assume you have $24,000, let's say, of distribution or annuity payments coming in, and you earn $24,000 from Social Security. So now we're going to calculate, and you'll see down here that $6,200 of your Social Security benefit is going to be subject to tax. So you'd go up here. If you want to switch it to married, you could run that the same numbers. Now it's only $2,000 is going to be subject to tax. So the important thing to note is that, when we say you have to pay tax on 50% of your Social Security benefit or 85% of your Social Security benefit, that's not the amount of tax that you're paying. That's just the portion of the benefit that gets added into your income for your tax calculation. So the next thing I'm going to do is I'm going to hop over to a tax calculator, and I just pulled this up online. It's just a simple tax calculator. And to show you now what your actual tax payments are going to be based upon these numbers. So let's assume you're single, you have $24,000 in Social Security benefits, you have $24,000 in other income, and so $6,200 of that money is going to be subject to Social Security tax. So this tax calculator isn't perfect, but it will work for our needs today. So you have $24,000 in other income, plus you have the $6,200 that is going to be subject to Social Security tax. So we are going to enter that number in. So $24,000 plus the $6,200 is $30,200. And your total federal tax is going to be $4,175. But let's say that instead of earning $24,000 in additional income, you earn $34,000 in income from your distributions and pension annuities. Well, what that means is now $14,000, I think it's $270 of your Social Security benefit is going to be taxed. So we're going to take the $14,000, I'm just going to do $14,000 for easy numbers, $34,000 plus another $14,000. It's going to be $48,000. So before you paid $4,175 in tax, now you're going to pay $7,673 in tax. So you see, and I'm going to talk a minute about this tax torpedo, but I kind of want to show you a number what this looks like. So even though your income only jumped up by $10,000, your tax payment jumped up by over $3,000, which is way higher than it would typically be for someone in the 22% tax bracket. So I'm going to talk about this more in a minute, but I just wanted to give you a little visual illustration. So hopefully now you have a bit of an understanding about how they go about determining these numbers. Now here's where we run into a major issue that's called the tax torpedo. And this particularly impacts people who are middle income. People in the lowest tier of income aren't impacted by this, and higher income individuals aren't as impacted by this. But if you're kind of in this middle tier, you end up getting hit with the tax torpedo. So let's assume that you have, let's make these numbers easy. You earn you're single and you earn $25,000 a year, either from a pension or an annuity, or you're taking a distribution out because you need $25,000 to live. So you're taking a distribution from your 401k or your IRA. So you pull out $25,000. So you automatically are going to, assuming there's no other deductions, you're automatically going to be in the tax bracket where at least 50% of your Social Security income is being taxed. Now, you might not have any extra money than someone who's earning significantly more in Social Security, but more of your Social Security benefit is going to be taxed because you have this other income that doesn't get any sort of discount. Let's say you have $34,000 and you're single and you have $34,000 in fixed income coming in, from, I don't know, when you've got dividend funds paying out or you've got an annuity or whatever it might be, then 85% of your Social Security payment is going to be taxed. There is no break for you, even though you might not actually be in a very high tax bracket. And this is why it really hits people in the middle income area, because they need other income sources to help make ends meet. But when they do that, that ends up causing a higher percentage of their Social Security payments to be taxed, which ends up driving up their marginal tax rate. So marginal taxes are essentially what you pay on the next dollar you earn. So if you earn $9,800, you're going to pay 10% tax on that first $9,700, and you're going to pay 12% tax on that additional $100. Let's say you earn $40,000. For most of that money, you're going to pay either 10% or 12%, and your effective rate is a blend between the two. And then anything over and above that $39,475 is going to be taxed at 22%. But because if you have a fixed amount of money coming in from a part-time job or whatever it might be that could push up your provisional income, that means that potentially the next dollar you earn, not only are you going to be taxed on that next dollar you earn, but it also could end up driving up the amount of your Social Security that's taxed. In fact, it can drive your marginal tax rate up to almost 42%. Now, what happens as you earn more money, that rate begins to come back down because there's not as big of an impact. That's really complicated. I could spend an entire episode talking about the Tax Torpedo, but my goal for this episode was to keep things as simple as possible. If you just want to Google the Tax Torpedo, there are a number of academic papers and a giant rabbit hole you can go down. But the next question then becomes, how can I avoid paying tax on my Social Security? And particularly, how can I avoid this Tax Torpedo? And this is where you might want to actually delay taking your Social Security payment until age 70. So I did another whole episode on when should I take my Social Security payment? Should I take it at age 62 or full retirement age or age 70? I'll link to that here if you want to go through and watch that whole video. But for this, I want to walk you through these numbers so you can kind of see what this would actually look like. So we have person A who takes Social Security at age 62. We have person B that begins at taking Social Security at age 70. They both need about $70,000 a year in income to live. Now, person A receives $36,000 because, they took it early, so they receive a reduced Social Security benefit. Person B receives a little over $52,000, and then they need some other income. So the first person had to take maybe pulled more from an annuity or from their 401k distribution. So they'd have about $37,000 in income that's coming in. Person B, because they have a higher Social Security payment, they don't need as much, so they have about $17,000, $18,000 in additional income that they're bringing in. Now, the provisional income for these two people is going to be significantly different because person A has way less Social Security income and has to make it up from other sources. So their provisional income is going to be $56,000. Provisional income for person B is going to be about $44,000. Now, here's where it gets really interesting. Person A, even though they have a much smaller Social Security payment, is going to have $16,000 of their Social Security income taxed. Person B, who has a much higher Social Security payment, is only going to have about $6,000 taxed. And their AGI ends up being $53,000 and then $23,000. And the taxes paid by person A is almost $3,000 a year compared to the federal tax paid by person B, which would be $0. They both end up with about $70,000 in after-tax income, but person A ends up paying significantly more tax on their Social Security than person B. Does all that make sense? It's a little tricky. So if you delay taking your Social Security at age 70, then that gives you some time in those preceding years to begin controlling your future income. One of the most important things in retirement is going to be controlling your income. How do you go about doing that? One of the best ways to go about controlling your income is to do a Roth conversion. So if you have a ton of money sitting in a 401k or an IRA, which is where most Americans have saved their wealth, if you begin rolling that money over, say you retire at age 62, you don't have a lot of income coming in. So you begin rolling that money from your 401k to your Roth. You do that Roth conversion. Once the money's in the Roth, it can grow tax-free for the rest of your life. So any additional capital gains are going to be tax-free. So we'll often run these numbers for our clients. We'll first say, okay, you're going to retire at age 62. You're not going to take Social Security until age 70. So you've got 8 years where you have a very low income. So then how much money can we convert to keep you under the 22% tax bracket? Because we don't want to bump you up in the 22% tax bracket. Or, you choose your number. You have to run the calculation to see which tax bracket makes sense. And then you use those 8 years to begin doing your Roth conversions. And so now you've taken your money from your 401k and put it in your Roth. And now you don't have to do, assuming you've taken all the money out of your 401k, now you don't have to do RMDs at age 75, and you're able to control your income. So therefore, if you need a little bit of income in retirement, you can just pull it out of your Roth later on, and it won't be considered as taxable income. And because you delayed taking your Social Security, you didn't have to pay tax on your Social Security benefits, in those years when you were making your conversions. Does all that make sense? Is anyone still watching? I know this is really technical, but it could end up saving you a fortune in taxes over the long run. Now, there are a ton of considerations. Some people, this just isn't going to work for because you have a large annuity payment or because you have a giant pension or whatever the case might be. But for others, if you have the ability to control your income through doing a Roth conversion or through actually taking money from your taxable account, you can often pull money from your taxable account also without creating income if you're strategic about the way you go about doing it. So by making those conversions and controlling your income, you're able to potentially avoid tax on your Social Security, and you're also potentially able to avoid higher Medicare premiums as well. And so that's a strategy that you might want to consider working through. In fact, we have some DIY software that we're going to make available soon that would let you run some of these numbers so you can actually begin to play with it and see what the tax impact would be, let you see what's the most tax efficient strategy. So in a few weeks, I'm going to have a video that I'll have coming out where I'll walk you through exactly how you can run some of those calculations on your own. And I think you'd be really surprised at how much it can save you over the long run. Hey, thank you for sticking with me to the end. I know this was a bit of a complicated topic, but I also think it's a really important topic because one of the largest expenses in retirement can be taxes. And so if you can learn how to control those tax payments, it could really help you have a much larger nest egg over the long run. Thanks again for watching. If you enjoyed this content, if you'd click the like button, subscribe, ding that bell, leave a comment, all those things help the Google algorithms know, or the YouTube algorithms. I can never get that right. I guess they're one and the same. Know that this is content worth watching. Thanks again.